the election is going to be something every investor, offshore, local, everybody's going to focus on. The view of our research is that it's going to be much tighter in 2015 than 2015. So we're going to get a more tighter election this year than we had in the last election. The key reform implementation will slow down. So electricity reform, petrol subsidy, and these are things that occur when there are balances that need to be struck between the political move as well as the economic move. So we do expect to see that slow down a little bit. Economic recovery is dependent on the oil sector. Nigeria is still oil dependent to a large extent. So what do we mean by that? Production, oil price needs to be very, very strong for the economy to continue to improve. So consumer is still stretched. The layman still feel a little bit of stretch in the system. So if you talk to anybody on the street, you will find out that the consumers are still stretched. Inflation is expected to moderate, although upside pressures from high food and petrol prices persist. So you will see, we expect inflation to drop to about 13.5%, but it's going to be held a little bit because of the pressure of food, as it were. Central bank will lose an effective monetary rate. So you will see interest rates start coming down. Why? Because the central bank wants to boost growth. That's one side. Then secondly, where the rates are, considering the liquidity in the system, considering the external raising of Eurobond that has occurred, we don't expect the pressure to be on the local currency interest rate as it was in prior years. So you see that trending downwards, and the central bank is going to mirror that. The private sector growth is set to rebound, but only moderately because people are still careful in terms of spend, as it were. Corporates may favor capital market issuance over traditional bank loans due to lower interest rate environment. We're already seeing that. We're seeing bond issuance beginning to start more and more, something that wasn't there a couple of years ago. We have two kind of exchanges now. The normal exchange, and then we have FMDQ, where private companies are beginning to raise a lot of CPs and are going to start issuing bonds as we go down the line. So we do see that being a direction as we go down the line. Financial institutions earnings may come under pressure as yields on T-bills decline. T-bills were as high as 21% in terms of yield. Now we're seeing them at about 15%. That is going to affect investment, the financial institutions' results, because significant amount of what they've earned in the last few years has come from T-bill yields, lending to government effectively. So banks will see every way they can make money. They will increase their fees, but I think there's going to be a lot of pushback on that. So generally, we don't expect them to actually have significant growth in terms of revenue in 2018. Current account will remain surplus. USD NGN is something I want to just spend a few minutes to talk about. So if you think about the exchange rate of Nigeria, some of the drivers of that exchange rate has been inflows from offshore as well as oil price. So if I think back in 2015, when the oil price shock occurred, we saw foreign investment in Nigerian fixed income and equity drop from $20 billion to $2 billion. Now that itself affected the reserves because all the inflows that had come in had gone out. Then the company was also under a little of pressure in terms of the supply of foreign exchange through the oil and gas that we usually export. That has changed a bit. We've seen oil go back from 39, 38 to about 70, 68 the last time I checked. We've seen foreign investors see the economy and see more positive flow and say things that are changing in the right direction. So we've seen a lot of flows coming. So in this year alone, we've seen about $11 billion coming to the country in terms of investment in that side. And that has helped the reserves significantly. Reserves have grown from what we saw of 30 earlier in the year or late last year, and we're now about $46 billion as at now. That itself is an import cover of about 1 year. Now, with an import cover of about 1 year, you expect confidence to continue to be what will be running through the system. But what do you look out for? So offshore people are going to start thinking about politics. So because the investment in T-bills is about $8 billion. Now, what you will see is as we move towards election, some will be uncertain and we're asking themselves a question, what do we do? Should we stay? Should we go and come back? We expect that a few will leave, but not a majority. That itself might put a little pressure on the exchange rate. So we think throughout the year the exchange rate is going to be a little bit stable, But as we move towards the last quarter of the year, for a couple of reasons. One, elections. The second thing is hedge funds, private equity funds, asset managers, they always like to square out at year end. So they'll be asking themselves, should we take it out? And we expect that to put pressure on the exchange rate. So towards the end of the year, we expect exchange rate to go to about 385, which is a small move if you think about all the movement you've seen in terms of exchange rate in Nigeria. So we expect that to go, but we don't expect a significant pressure. Now, it also depends on how the central bank responds. So if the central bank is quick to step in, because they do have a good ammunition to be able to respond. So if they step up, then we don't see any movement at all. We expect that 2019, after the election, there should be stability and things should just keep improving well. So fiscal account will improve with upswing in oil price and production. It is still dependent on oil price, dependent on oil production. But the perception and the view is that oil price is going to go up at least for the end of this year and stabilize about that 70, 75. We expect that the non-oil revenue drive of the government will gain traction. It's going to take a while. It doesn't happen overnight. There's no economy in the world where that thing has kicked up in 1 year. But at least the foundation is being laid, and hopefully with the increase in tax income that they are driving through the VATs, we should see an improved income coming to the federal government, which gives them the ammunition as well to be able to do what they need to do in terms of growth.